If you want to make big money, then you have to learn how to catch a trade that follows the higher time frame momentum. Just think about it. Which do you think will make you more money? A trade where the weekly time frame is bullish, the daily time frame is bullish, and the H4 time frame is bullish, or a trade where the weekly time frame shows a bearish engulfing pattern, the daily a doji candle, and the H4 chart a bullish engulfing pattern. Well, I think it should be pretty obvious that in the first scenario, you are more likely to catch a momentum trade that makes a ton of money. So in this video, I want to show you a high probability, higher time frame momentum trading strategy that you can start testing out today. The idea is simple. We want to align the higher time frame momentum with the lower time frame and use the lower time frame to time our entry. By drilling down to the lower time frame and fine-tuning our entries, we can get in with a tighter stop loss. And if the momentum continues, that's how we catch those big juicy reward to risk trades. Trades that yield 1:5 or even 1:10. If that sounds good, please do me a small favor and hit that thumbs up button. I really appreciate it. If you are new to the channel, do tap that subscribe button because we upload new trading tutorial videos like this every single week to help you become a better trader. Now, if you have not already joined our Telegram channel where we send out our trade signals, definitely join us. It's free to join and you can find the link to join in the description down below. Moving back to the strategy, let me give you an overview of this strategy before walking you through each of these steps. Step number 1. Check the weekly chart for an engulfing pattern. Step number 2. Check the daily chart for an engulfing pattern. Step number 3. Drill down to the H4 chart and look for an engulfing pattern or inside bar. And step number 4. Enter the trade and input your stop loss and take profit. As you can see from the steps, we will be relying a lot on an engulfing pattern and the inside bar. So let me do a quick refresher about how an engulfing pattern and inside bar looks like. Right here, this is an example of how an engulfing candle looks like. As the name suggests, the current candle engulfs the previous candle. It doesn't have to engulf the entire range of the candle, though it is better. A candle qualifies as an engulfing pattern as long as it covers the body of the previous candle. So moving on, this is how an inside bar candle looks like. And if you observe it, it's the opposite of an engulfing candle. The previous candle engulfs the current candle. Now, it is important to note that the current candle has to be inside the range of the previous candle, meaning that the current candle's range must not exceed the previous candle. I have previously uploaded a video that teaches you how to use the inside bar trading strategy to catch explosive moves. In that video, I explain the underlying psychology and why an inside bar pattern works. So if you have not watched that video, please check out that video next. I will leave the link to that video at the top right corner and at the end screen of this video. So now that we got the two candlestick patterns out of the way, I want to walk you through the strategy step by step. Step 1 involves checking the higher time frame for an engulfing candlestick pattern. So right here, we are in the weekly chart and we see a nice bullish engulfing pattern right here. For this engulfing pattern, the price closes above the previous candle's high as well, and that's an odds enhancer. Step number 2, switch over to the daily time frame. And we repeat the same thing. Look for an engulfing pattern. Now obviously, if the weekly time frame is a bullish engulfing, then we want to watch for a bullish engulfing candle in the daily time frame. We want to align ourselves with the higher time frame. Do not start looking for bearish engulfing patterns. If you see one, just be patient and wait for a bullish engulfing pattern to occur. Once we get that, then it's time to move on to step number 3. Step number 3 is where we look for our entry in the lower time frame. So drop down to the H4 time frame and it's time to look for an engulfing or inside bar candlestick pattern. For this example, we have a bullish engulfing candlestick right here. Once we see that, it's time to move on to the last step, step number 4, which is entering the position. Upon the close of the engulfing pattern, we can go ahead to take the trade. The stop loss goes below the low of the engulfing pattern with a buffer. Now, a buffer is necessary just in case the price spikes. As for the take profit, it's really up to you. But if you need a hard and fast answer, I will recommend using a fixed risk to reward of 1:3 as take profit. If your stop loss is 30 pips, you will set in a take profit of 90 pips. But if you are a little more experienced and know how to throw your stop loss, that's something that you could do as well. Personally, I opt to do that because I have the experience, and remember, we are trading with the higher time frame momentum. Thus, if price starts to trend on the weekly chart, that could potentially mean a lot of money. I'm talking about big juicy reward to risk trades like 1:10. But anyhow, that's if you are more advanced. I have previously uploaded videos on this channel showing you how to manage your trades using exit indicators and also other tips on maximizing your profits. So that's a reason why you should subscribe if you haven't already done so. So let me show you another example before ending off this video. This time, let's do a bearish scenario. Switch over to the weekly chart and look for a bearish engulfing pattern. Right here, we see that there is one. Once we see that, drop down to the daily chart and repeat this process. And right here, we see another bearish engulfing pattern that lies within the weekly bearish engulfing pattern. Oh, by the way, I didn't mention it earlier, but it is important that the bearish engulfing pattern found in the daily chart still results in a bearish engulfing pattern in the weekly chart. You don't want to be looking for a bearish engulfing pattern in the daily chart if the price flips and the weekly chart no longer shows a bearish engulfing pattern. Now that the daily chart shows a bearish engulfing candle, it's time to move on to the H4 chart to look for our entry. Right here, we see that there's a nice inside bar setup. So wait for the price to break the low of the inside bar. Once we see that, we can take the trade using a market entry order. The stop loss goes above the high of the inside bar pattern, and don't forget to input a buffer to give the trade some room to breathe. And that's the entire trading strategy. Such setups are high probability, but granted, you might not get many of these in a trading week. Often, what happens is the weekly chart doesn't align with the daily, or perhaps the H4 chart doesn't align with the daily. Nonetheless, this is a good momentum trading strategy that you can incorporate into your trading arsenal. So summing up this video, this high probability momentum trading strategy deals with aligning the weekly chart with the daily and H4 chart. We are looking for an engulfing pattern on higher time frame and fine-tuning our entries in a H4 chart using either an engulfing pattern or an inside bar. Now, as promised, I will leave a link to the inside bar trading strategy at the end screen right here. You probably will find more setups with that strategy, and if you enjoyed this strategy or are into momentum trading, then that's the video I recommend checking out next. Thanks for watching, and don't forget to subscribe. I will see you in the next video.